You didn't lose your job because you were lazy. You didn't lose your savings because you were stupid. America didn't fall into the Great Depression because of bad luck. It collapsed because the entire system was built on one dangerous belief: growth is permanent. In 1929, the United States was the richest economy on earth. By 1933, 1 out of every 4 workers was unemployed. Banks were gone, farms were dust, cities were starving. No invasion, no plague, no natural disaster, just math, debt, and denial. So the real question isn't what happened, it's why nobody stopped it, even when the warning signs were screaming. After World War I, America didn't just win militarily, it won economically. Europe was shattered, factories destroyed, currencies unstable. America stepped into the vacuum. Its factories didn't stop producing. They accelerated. Cars, radios, refrigerators, consumer goods flooded the market. Henry Ford's assembly line cut production time from 12 hours to 90 minutes. That single efficiency shock reshaped capitalism. But here's the flaw most people miss. Production surged faster than wages. America could make more than its people could afford to buy. That imbalance is where everything starts going wrong. Instead of raising wages, the system chose a shortcut: debt. Buy now, pay later. Installment plans. Easy credit. Radios on credit, cars on credit, furniture on credit. Even groceries sometimes. On paper, consumption stayed strong. In reality, Americans were borrowing future income just to survive the present. This wasn't prosperity, it was time theft, and Wall Street took notes. The stock market became the ultimate fantasy machine. Margin trading allowed investors to buy $100 of stock with $10 the rest was borrowed. This works only if prices rise forever. Between 1924 and 1929, the Dow Jones quadrupled.
Ow.
Not because companies were suddenly 4 times more profitable, but because belief replaced analysis. Price became proof. Barbers gave stock tips. Shoeshine boys pitched investments. Banks encouraged speculation with depositors' money. That last part matters. Banks weren't just observers, they were participants. They lent recklessly. They invested deposits. They blurred every boundary. No regulations. No guardrails. No brakes. The system was already cracking before the crash. Farm incomes collapsed after wartime demand vanished. Consumer debt skyrocketed. Corporate profits flattened. Inequality widened sharply, but optimism drowned out data. When economist Roger Babson warned of a crash, markets dipped, then rallied harder. Why? Because the system punished caution. Anyone who sold early looked stupid until they looked prophetic. This is the most dangerous phase of any bubble, when reality becomes unpopular. October 29, 1929, the market didn't crash. It collapsed under leverage. Margin calls exploded. Forced selling fed more selling. Liquidity vanished. $14 billion evaporated in a single day, over $200 billion today. But here, the uncomfortable truth. The stock market crash didn't cause the Great Depression. It exposed it. The real damage came next. Banks had lent too much, invested recklessly, held insufficient reserves. When loans failed, banks failed. When banks failed, savings vanished. No FDIC, no insurance, no safety net. People ran on banks not because they panicked, but because they were rational. And rational behavior at scale destroyed the system. Over 9,000 banks collapsed, money disappeared, trust died. Unemployment hit 25%, factories shut down, cities hollowed out. Breadlines stretched for blocks. This wasn't temporary hardship. It was systemic paralysis. And then came the Dust Bowl. Overfarming plus drought equals ecological collapse. Millions displaced. Entire regions abandoned. America didn't just lose money, it lost stability. And with stability gone, extremism followed. Herbert Hoover believed the market would self-correct. It didn't. He opposed large-scale federal aid, prioritized confidence over calories. Hooverville sprang up nationwide. Then came the bonus army, veterans, families, tear gas. When the government attacked its own soldiers, legitimacy shattered. America didn't trust capitalism. It didn't trust government. It trusted nothing. Franklin Roosevelt didn't promise miracles. He promised action. Jobs, programs, bank reform. market regulation, FDIC, Social Security. These weren't socialist fantasies. They were structural repairs. Capitalism didn't die in the Great Depression. It was forced to grow up. The Great Depression wasn't caused by greed alone. It was caused by unchecked leverage, fake prosperity, ignoring inequality, treating markets like gods, and here's the uncomfortable part. None of those conditions are ancient history. If you think this could never happen again, you've already learned the wrong lesson. Because the Depression didn't begin with a crash. It began with confidence. And confidence, when unearned, is the most expensive lie a society can tell itself.